Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 11th of January 2024 and here are the questions we will be answering today. How can Indian Airlines balance pilot fatigue and profits? Are India's auto dealers facing a problem of plenty? Is it time to book profit in real estate stocks? And what is a stock split? The Indian aviation sector not just shrugged off the pandemic blues, but it also broke all the previous records in 2023. The country's domestic air passenger traffic soared past 150 million last year, despite the grounding of a big carrier in May. But it also meant that airlines were stretched like never before and pilots were operating under extreme pressure. At least 3 of them reportedly died due to heart attack last year. Now, the civil aviation regulator has come up with a set of new rules. Will these rules ease the burden on pilots, and how will it affect the airlines? Kasturi Akhil has the answer.
India's civil aviation regulator, the Directorate General of Civil Aviation, has proposed a set of reforms to the existing rules governing duty timings of flight crew, including that of overstretched pilots. Civil Aviation Minister Jyotiraditya Scindia recently told a news agency that these rules are closely aligned with global standards and that they will put a much more facilitative regime for pilots in place. The new rules will come into effect from 1st of June. Let's see what these proposed changes are. Pilots' weekly rest period has been increased to 48 hours from the current 36 hours. The definition of night has been extended by an hour from midnight to 6 am. Right now, it is 12 am to 5 am. It will give flight crew an extra hour of rest during the early morning. Night landings will also be limited to 2 against 6 earlier. Apart from this, the airline operators will be required to submit quarterly fatigue reports, including the details of action taken to the aviation regulator. 2023 was also the year when airlines struggled to operate at full capacity on the back of several financial and engine-related issues, including the grounding of about 160 aircraft powered by Pratt & Whitney engines. These numbers, when juxtaposed with the current fleet of commercial aircraft, which is just 700, suggest how underserved India's 152 million air passenger traffic was. India's second largest carrier, Air India, had to reduce weekly flight frequencies to the United States for about 3 months in early 2023. The airline also slashed flights to West Asian countries due to crew and plane shortages. So it makes some experts believe that the fresh changes might cause some turbulence in flight schedules and could also impact operating costs, as the domestic aviation sector has been grappling with aircraft and crew mismatch for some time now.
To some extent, there will be an impact on operating costs. Airlines will have to get more pilots. They will have to get more engineers. The crew shortage is something which is not, we've known about this for the last 7-8 years now. It's a global phenomena. The average age of a captain to a co-pilot is almost 15 to 20 years. That gap has to be shortened. We need more pilots, but we need qualified pilots. We need type-rated pilots. We need experienced pilots. We need pilots who have at least 3,000 flight hours. The solution to this is bringing in expat pilots as well. But the government and airlines are being very quite tight-fisted because they really don't want to lose the grip on Indian pilots, because obviously there is a price competitive challenge.
India currently has 9,000 pilots who fly its 700 aircraft. Together, Boeing and Airbus are expected to deliver about 1,100 aircraft to Indian Airlines over the next decade. According to an estimate, induction of these new aircraft would mean about 15 to 16 pilots per plane would need to be deployed to meet industry standards. So, we'll need 17,000 to 18,000 trained pilots in total. And this implies that the country needs 1,700 to 1,800 pilots per year on an average. Currently, DGCA is registering only 600 to 750 commercial pilot license holders every year. Clearly, that gap is wide and needs to be filled. And apart from this, Indian Airlines, including Air India, had accumulated losses of $7.9 billion between financial year 2010 and 2023, of which $3.1 billion was prior to the pandemic period. But airlines are now coming out of the rough weather. Indigo reported a net profit of 189 crore rupees in July to September quarter of FY24 against a net loss of 1,583 crore rupees in the same period last year, while SpiceJet too has narrowed its loss. Air India under the new management is also trying to turn the corner. So clearly, there is a silver lining. Going forward, can airlines keep up as more and more people fly?
Pilots' fatigue is obviously important. You can't compromise with safety. But at the same time, India has to start providing for institutes to get the pilots ready by the time new aircrafts come. So we need to think about how do we generate more pilots in India rather than compromising with safety. So these guidelines were much required if we want to meet international standards. The country is marching towards developed country, so we need to have these regulations in place. Yes, profitably, maybe in short run would be impacted, but in long term, ultimately the airlines would recover it from the passengers. So it will not be a dent on the profitability. In fact, it will provide a more safe environment for passengers to travel, and in long term, the country would benefit and airlines will also be able to be profitable.
Clearly, the country's fast-growing airlines need more trained crew and pilots. It will not just take some load off from the existing employees, but will also lead to better services. Airlines still have 6 months left before the new rules kick in. Meanwhile, the government should also try and address the pilot shortage issue and find a solution.
And thanks to the holidays, last December saw the highest ever air passenger traffic in any month in the history of aviation. Like the skies, records were set on the ground as well. Sales of passenger vehicles crossed the 4 million mark for the first time in 2023. Car sales had broken the record in 2022 as well. But now India's auto industry is facing a peculiar challenge. Car dealers have reported a 75% jump in unsold inventory at the beginning of this year as compared to January 2023. So what explains this dichotomy? Abhijit Kumar finds out.
The year 2023 was remarkable for the Indian automotive sector. It saw an unprecedented surge in vehicle sales. While families upgraded to new vehicles, auto enthusiasts reveled in the new models offered by automakers. The annual volumes of cars, sedans, and utility vehicles breached the 4 million mark for the first time in 2023. This was an 8.2% increase from 2022, where 3.79 million units were sold. In a sign of increasing annual vehicle sales, data available on the Vahan portal as of 31st December 2023 showed registrations were up more than 11% in calendar year 2023 as compared to 2022, which saw 21.5 million units being sold. The sale was around 23.9 million units, marginally behind by 1% when compared to 24.17 million in 2019. However, beneath the hood of this positive sentiment lies a growing concern: the surge in inventory levels for passenger vehicles. It is crucial to note that the sales figures of automotive manufacturers only reflect the quantity of vehicles passed on to dealers. According to the automobile body, Federation of Automobile Dealers Associations, or FADA, the year 2024 began with the passenger vehicle inventory at 650,000 units at the dealer level. And this inventory pent-up is not new. It hit an all-time high in August last year. Even during the festive season of 2023, when sales were robust, the PV inventory was stacking up. FADA President Manish Raj Singhania in November had said inventory levels for passenger vehicles remain a significant concern. as OEMs continue to push further dispatch, thus keeping the inventory rate at near to all-time high levels. In October 2023, the inventory ranged from 63 to 66 days. As for November, just after the festive season sales, the average inventory of passenger vehicles ranged from 61 to 63 days. FADA noted. It dipped to 55 to 58 days at the end of December. Maintaining inventory beyond 30 days is believed to erode profitability for dealers. This is due to the financial burden brought about by the high interest costs of inventory funds. So, Puneet Gupta of S&P Global Mobility explains the dichotomy between record vehicle sales and the growing inventory.
We entered 2023 with a very, a high pent-up demand. So there was almost waiting period for almost most of the cars, which really, helped 2023 volume because, somewhere you may not be able to see that waiting period, which actually has been translated into retail sales. If we go back almost 1 year, the dealer inventory was around 35 days, whereas generally before pandemic, it was roughly around 50-55 days. But now, in 23 December, so basically the inventory went up to the level of around 65-70 days. When the inventory went up, we saw heavy discounting, because generally every dealer would like to revolve his working capital. But for most of the models, but for most of the industry, so the pent-up demand is over.
To add to the woes, PV sales in 2024 are expected to start on a weaker front due to the Kharmas period, during which the demand is anticipated to slow down, according to FADA. It has given a cautious optimist outlook for the year, emphasizing that the inventory pileup and effective supply management need to be worked out. Analysts believe that auto manufacturers, in their eagerness to meet the growing appetite for new vehicles, have inadvertently flooded the market, leading to surplus inventory. With record demand in 2023 for PVs, OEMs continued bringing newer models and upgrading existing ones. Also, in the excitement to cut short the waiting period for more sales, dealers stocked up on more units. So, how can the industry deal with the inventory problem?
Yeah, so you see there are two extremes here. There is an agency model where dealers carry zero inventory. Okay. And there is stock and sell model where dealers have to carry inventory. So in agency model, the OEMs like Mercedes, they have decided to have an agency model. Dealers have no inventory, right? But agency model takes away a big role of the dealer, right? Dealer is a stocking company and a selling company. Dealers will love 30 days, OEMs will love 60 days, but nowhere in the world we have 30 days. 30 days is an unrealistic expectation because you have how many models and variants you have to cater, right? There are more than 1,300 variants. So you have to keep the color stock, you have to keep the choice to the customer. So I think 30 days is a bit too ambitious, and that will lose a loss in market share for car companies. Ideal is about 45 to 50 days.
While discounts and promotions can boost short-term sales, they can also impact profit margins and brand value in the long run. The industry must strike a balance between meeting immediate sales targets and maintaining a sustainable business model. Auto experts believe that the imperative lies with OEMs and dealers to collaborate closely, employing strategic measures to maintain equilibrium between supply and demand.
Let us now turn our focus to the financial markets. Shares of real estate firms have been firing on all cylinders, outperforming the markets over the past 1 year. The Nifty Realty Index has doubled investors' wealth in 1 year, while some stocks have generated 3x returns during this period. Going ahead, is there more in this rally, or are stock prices overheated? Nikita Vasisht brings us the report.
India's real estate sector has woken up from over a decade-long slumber and so have the stock prices. On January 9th, the Nifty Realty hit an all-time high of 869 level, having doubled over the past 1 year. The stocks too have been on fire. Shares of Prestige Estates projects, for instance, have zoomed 190% in 1 year, while those of DLF and Sobha have surged up to 118%. Godrej Properties, Oberoi Realty, and Mahindra Lifespace too have jumped in the range of 56 to 84% during the period. By comparison, the Nifty 50 index has gained just 19% in 1 year. Analysts attribute these gains to Real Estate Regulation and Development Act and Goods and Service Tax. The two reforms, they say, helped organized players gain market shares as they have more capital and better technology to deliver housing units on time.
The industry is experiencing margin expansion. The sector is expected to do well because the demand for the luxury segment is very robust and is continue to remain very strong. And the presently tepid growth being experienced by the affordable segment is also likely to pick up.
Data by Anarock Research suggests housing sales in the top 7 cities, including Delhi, Mumbai, and Bengaluru, created a new peak in 2023, with around 476,500 units being sold, as against 364,900 units in 2022. On January 8, realty major DLF said it sold over 1,100 luxury apartments in Gurugram for 7,200 crore rupees within 3 days of its pre-launch. That said, the steep rally in stock prices has stretched the valuations, making them unattractive for near-term perspective. The Nifty Realty Index is trading at a trailing 12-month price-to-earnings multiple of 86.3 times, as against the 5-year historical average of 69.4 times and 10-year average of 55.2 times. Among stocks, Sobha is the most expensive with a PE ratio of 119 times versus its 5-year average of 43.2 times and 10-year average of 31.4 times.
Most of the good news are already in the price. Therefore, investors who are sitting on very good profits can partially book profits even though the prospects look good. For new investors who are thinking about entering the segment, entering now at elevated valuations would be risky.
Heated valuations and cyclical nature of the sector thus make it prone to steeper corrections in the near term. Long-term growth outlook, however, remains intact. On January 11th, Q3 results of 5paisa, HDFC AMC, Infosys and TCS will be on investors' radar.
He's making plans for an early retirement. Business Standard.
Staying on financial markets, FMCG giant Nestle India recently announced that it will split its shares and give 10% shares for every one that its shareholders hold. Currently, the Maggi maker has one of the most highly priced shares in the Indian stock market. But what is a stock split? Why do companies do it? And what changes after that? Watch this report for the answer.
A stock split is when a company divides the value of its share in a certain proportion. This increases the number of shares available in the market for buying and selling on the exchange. The total value or the market capitalization of the company continues to remain the same even as the number of shares increases. Let us understand this with an example. Suppose a company currently has 100 shares in the market priced at 20 rupees a piece. The total market cap currently stands at 2,000 rupees. It announced a stock split of 2 for 1. After the split, the company will have 200 shares in the market priced at 10 rupees a piece. The value of a share has halved and its price has doubled. The market cap, however, continues to remain the same at 2,000 rupees. A company may split their shares for a number of reasons. Usually, it is to improve the liquidity of the stock. If a company's share price is very high, it may discourage investors from investing in it or trading in it regularly. After a split, investors may be encouraged to trade in the stock more frequently. Another reason is to increase its investor base. This is because a low price share may attract small investors to put their money in the stock. The companies may also undertake splitting to get the attention of the market and investors. In 2022, Google's parent company Alphabet announced a stock split, giving investors 20 shares for every one they hold. In the same year, Amazon also announced a 20-for-1 stock split. Tesla had also announced a stock split of 3-for-1 in 2022. There are some cons of splitting as well. One is that the value of the shares does not increase and it still depends on the financials of the company. Another con is that splits may lead to high volatility following increase in trade frequency. And then there is reverse split. In this, a company merges several of its shares into one. This is done if a company believes its shares are undervalued in the market. This also prevents companies from getting delisted based on minimum share price requirements. After a stock split, an investor can still buy a full share of the company, albeit at a lower price. In fractional investing, however, an investor is allowed to buy a portion of a singular share. In India, reports suggest that last year regulator SEBI was working on introducing fractional investing. However, no official announcement has been made yet.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
India's largest public sector shipyard, Cochin Shipyard, too is following Nestle in its stock split. Its shares jumped about 10% on Thursday as the counter started X-split. Well, that's all for today. For more news and analysis, please log into our website, business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.